Hi, everybody. I'm Jerry Kronenberg, Director of Financial Content here at Moomoo Technologies Inc., and I'd like to welcome you to a very special webinar with a very special guest. Joining us today is Ken Keating, Principal for Investor Education at the Options Industry Council, and he's going to teach us the basics of options trading. Hello, Ken. Now, lots of folks always hear in the markets about puts, calls, gamma squeezes, triple witching hour, and other things like that, but not everybody knows what that is. For those of you who are unfamiliar with options, good news. We will teach you in the next hour or so all that you need to know to start looking at options trading. Now, as I mentioned, Ken is the Principal for Investor Education at the OIC, which is an industry-funded group set up in 1992 to help teach people about options trading. Before that, he spent 25 years as an options floor trader or floor specialist and other roles at Group 1 Trading, where he worked on the Pacific Coast Stock Exchange and the Chicago Board of Options Exchange. He also later served as an options portfolio manager for Peak 6 Capital Management and elsewhere. Now, before we get started, I'd like to remind you this is an interactive video, so please submit questions to us via the chat group of this event, and we'll try to get to some of the in the end. Now, without further ado, though, I'm going to hand over to Ken, and Ken is going to teach you a class called Getting Started with Options. So let's all pay attention. Ken, welcome.
Thank you, Jerry, and thank you for taking time out of your busy day to join us. So as Jerry mentioned, my name is Ken Keating, and I'm a principal at OCC Investor Education, as well as an Options Industry Council instructor. And I'm going to be giving today's presentation on getting started with options. So just to give you a little quick background on myself, I've been at the Options Clearing Corporation for roughly about 5 years now. But previously, before coming to OCC, I was a professional options trader for well over 25 years. So I started out on the floor of the Pacific Coast Stock Exchange as a market maker. I then moved in the early 90s to the Chicago Board of Options Exchange, where I worked as a floor market maker as well as a floor specialist. I ran off-floor prop desks. I've run risk management desks. I worked for one of the largest privately held market making firms at the time for roughly about 15 years. I then moved to a capital management firm where I ran an off-floor prop book, trading options off-floor, as well as trading for myself for many, many years as a sole proprietor. So currently I work at OCC, helping individuals such as yourselves to better understand both the risks and the benefits of exchange-listed options. So speaking of the risks and the benefits of exchange-listed options, we always have to mention our disclaimer. Options are rather complex vehicles and need to be properly understood before trading in a live account. So anyone who's considering options should thoroughly read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org to download a free digital copy. Or if you prefer a physical copy, you can always reach out to your broker or any exchange on which options are traded. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. All right, here are some of the trademarks and logos you will see throughout the presentation. These are just for all the lawyers at OCC. All right, this is annual options volume over the last 20 plus years. And as you can see, the growth and trajectory of the product has just been phenomenal. So I left the Chicago Board of Options Exchange right around the beginning of 2000, end of 1999, 2000. And back here, we were trading roughly about 2 million contracts on a daily basis. So 2001, as many of you remember, was when the dot-com bubble popped. We were trading about 3 million contracts. But ever since then, the growth and trajectory of the product has been just incredible. So 2008 was the great financial crisis. 2011, the sovereign debt crisis. 2020, we were dealing with COVID. 2021, we were dealing with the lower interest rates, but then interest rates started increasing in 2022, the war in Ukraine. So certainly no lack of investors using the product both to hedge and speculate amidst all the volatility. So last year alone, we cleared a record 11.1 billion contracts. And currently we are averaging about 47.5 million contracts on a daily basis. So if we stay on this growth trajectory, we're probably looking to clear and settle roughly about 12 billion contracts for another record year. So the industry is thriving, and certainly more and more people are trading more and more options these days. Okay, so with that out of the way, let's get started. So today I'm going to be talking about options, and I'm going to be looking at options from a 10,000-foot overview. Okay, so this is just going to give you an introduction to options, what they are. So first I'm going to be talking about options defined. I'll then look at why people trade options, the flexibility of options, and the leverage they provide. I will then look at the two types of options, calls and puts, and then we'll get into some basic strategies, some of the more basic strategies that options traders use. And then finally, to finish up, we will go through the exercise and assignment process as they apply to options. So time permitting, at the end of the presentation, I'll bring back Jerry and we can hopefully entertain some live Q&A. So with that, let's just get started. Options defined. What exactly is an option? Well, simply put, options are contracts, and these contracts afford the buyer the right, but not the obligation, to either buy or sell 100 shares of a particular stock or ETF on or before the expiration of that option. Now, remember, there's always two parts to a trade. So for every buyer, there's a seller. So the seller of the contract takes on the obligation to either buy or sell the underlying asset. So if you take one thing away from this presentation, I want you to understand that in the options world, buyers have rights, sellers have obligations. Okay, so when you buy an option contract, you're kind of in the driver's seat. Okay, you can hold that contract. You can sell that contract out at any time on or before expiration. You don't have to hold it till expiration. And or you can also exercise that contract. We'll get into that process a little later, but you're kind of in the driver's seat. The seller, on the other hand, takes in option premium. That's theirs to keep. But now, because they have sold the option, they are now under the obligation to either buy or sell the underlying asset should the long holder choose to exercise that contract. And every option has a specific strike price. If you pull up an options montage for your favorite stock, you'll see various different option strikes at various different months. Okay, so there's all kinds of different months and durations and strikes that you can choose, and depending on your individual forecast and risk tolerance, you can pretty much design an option strategy just to fit just about any forecast that you might have. Now, every options contract has a finite life, okay? And at some point, whether that option expires in a day, a week, a month, a year, its life comes to an end. So at expiration, that option either has value or it doesn't. Okay, so we'll look at that a little later as well. So why options? Why do people trade options? Well, options give you a lot of different variety and ways to implement your forecasts, and it allows you to target a variety of investment objectives. Okay, so these are some of the ways that people use options. So people can use options to reduce risk. In other words, to hedge an existing, if you have an overly large concentrated stock position in one particular issue, you can use options to hedge that risk. You can use options to hedge the risk of an individual portfolio. You can use options to generate income. Okay, a lot of people will sell calls against their long stock holdings to create almost like a synthetic dividend stream to create an income generation scenario. Okay, so we'll look at the covered call example a little later. You can also use options to acquire stock at prices below where they are currently trading today, another income generation strategy. This is called the cash secured put. Every option is the right to either buy or sell 100 shares of stock, and people will use options to try and profit on a bullish move, a bearish move, or if the stock just stays flat and does nothing. Okay, so options offer you flexibility. So in a world without options, there's only really two ways to make money in a stock. You can either buy the stock and it goes up, or you can short the stock and it goes down. So most people in the market are long assets, meaning they own stocks, they own bonds, they own Bitcoin, whatever. They own those assets and they want those assets to appreciate over time. Somebody who's short the market, well, basically, if you're shorting a stock, you borrow that stock from your broker, from somebody who actually owns the stock. You sell it today. Let's say the stock's trading 100. You sell it today, and with the hopes that it goes lower and you can buy it back at a lower price. Maybe it goes down to 90. If you buy it back at 90, now you've replaced the stock that you bought, you pocketed a $10 profit. So people who sell stocks short, this is usually reserved for professional options traders, hedge funds, people like that, because anytime you sell stock short, there's unlimited risk to the upside, because theoretically, there's no limit to how high a stock can go, okay? But simply put, this is just the only way you can really make money trading stocks. You're either going to own the stocks and they go up, or you short them and stocks go down. Options, on the other hand, have many different ways that you can profit on a variety of different forecasts that you may have. So this isn't the complete list of all the option strategies. This is 18 of many different strategies, but you can make money trading options whether you're bullish, whether you're bearish, or whether you think stocks are just going to be range bound and trading in a tight little range. So certainly there's a lot more variety and flexibility with options. Okay, you can design an option strategy that pretty much fits any kind of scenario you can think of. If you think that a stock is going to be quiet for the next month, but then in the next month it's going to make either a big move up or down, there's a strategy for that. There's a strategy if you think the stock typically makes a 10% move for earnings, but the market is pricing in a 15% move. There's a way to capitalize on that. So once again, options give you choices, and this is why people love trading options, because there's so many different ways that you can structure them to help you achieve your investment objectives. Okay, with that said, let's get into the two types of options. So simply put, there's calls and puts. So calls, basically these options for most standard contracts are based on ETFs or equity, meaning stocks, okay? And each option is the right to either buy or sell 100 shares of that particular contract on or before its expiration. So one thing to keep in mind, so today we're going to be talking about American style options. So that doesn't mean they trade in America. That's the exercise style. So for American style options, those options can be exercised by the long holder. We'll get into the exercise and assignment process later. But exercise is basically the process by which an option holder takes delivery or delivers shares on their options. Okay, so American style options can be exercised on or before expiration at any time during the life of that option. European style options can only be exercised on expiration. So an example of a European style option would be options that trade on the big indexes, things such as the SPX, the NDX, the Russell. These are cash settled indexes. They're European style exercise, and they can only be exercised at expiration, on expiration, not any time before. But for our examples today, we're going to be looking at American style options. Okay, so equity call options. So call options are the right to buy 100 shares of the underlying. Okay, people who usually buy calls are bearish on their holdings. Okay, they need stock movement. They need stocks to move higher for these calls to take on value, because remember that every time if you buy a stock, okay, you're buying ownership in a company. Okay, that is a small piece of ownership in the company. If you buy an option, you're not buying ownership in that company unless, of course, you exercise your option. So you're buying the right, but not the obligation to buy those shares. Okay. So because every option has a finite life, as you get closer and closer to your expiration date, that option loses a little bit of value every single day. And it's through something called time decay. I'm not going to get into time decay today. That's probably for another webinar when to teach you about the Greeks. But just know that every day that you get closer and closer to expiration, that option is going to lose value. So let's just say a stock's trading for 100 and we buy a call that expires in a month. The 100 level call, that would be the at the money strike call because it's right at the strike or where the stock is trading. And let's say it's trading for $5. And we fast forward to expiration 30 days later. And if the stock is still at 100, okay, well, the right to buy stock at 100 with it trading 100 on expiration, it's not going to really have any value. Okay. That $5 in premium would just it would evaporate over the last 30 days. Okay. So just know that options decay a little bit in value every single day. So there's always two sides to a trade. So for every option buyer, there's an option seller. Somebody's selling you that call. So an equity call seller is going to receive that $5 or the premium for that option, and now is under the obligation to sell that underlying stock or ETF at their strike price on or before the expiration of that option. So typically people who sell, there's two types of people that sell calls, okay? There's people that already own the shares. They're selling calls against their long stock holdings. We'll look at that a little later, but that's more of an income generating strategy. But then there's people who don't own the shares, who are selling options because they're bearish or they're putting them on as part of a spread, maybe buying one option, selling another against it. But just keep in mind that when you sell, just like when you sell stock short, when you sell an option, a call option, okay, you have unlimited upside risk exposure because there's no limit to how high that stock can go. So just know that selling stock short and selling naked calls is probably the most risky thing you can do in the market. And, once again, there are ways to mitigate against that risk, but, just outright, very few people just sell calls naked. Okay. They're more than likely doing them against another option or doing it against stock holding. All right, so that is call options. So put options, what is a put option? Well, a put option is just the opposite. A put option is the right, but not the obligation to sell 100 shares of that underlying stock or ETF on or before your expiration. So if people don't own the shares, and they're just looking to speculate on a bearish move, they might buy puts. Okay, this affords you the right to sell shares at your strike price on or before expiration. And you might do this if you think a stock is going to go down, maybe on earnings, or maybe you think the market's overbought, or for whatever reason, it's a way to speculate on a downside move. If you already own the shares, you can use puts as protection. To kind of think of it like an insurance policy. If you buy stock at 100 and you're okay with a 10% loss on your stock holdings, but you want to cap it at that, you might buy a put at the 90 strike, 10% lower, to protect yourself in case shares go lower. Now you're going to be paying a little premium for that put, but in that way, you are protecting your downside in case the stock falls out of bed. Now, for the equity put seller, okay, by taking in that premium, if I sell a put, now I'm obligated to buy shares of the underlying at my stock price should the long holder exercise their contract, okay? We'll be looking at a strategy called the cash secured put. This is a way for people to sell options or sell puts in order to kind of get paid to wait while you're waiting for stocks to get down to a level you're comfortable buying them at. But an equity put seller is taking on the obligation to buy those shares should the long holder decide to exercise. So once again, selling puts naked is always kind of risky, but it's a way to generate income while you're waiting for share prices to drop. If the stock rallies and you're short puts, well, those puts would just expire worthless and you would keep 100% of the premium that you sold those options for. Okay, so really quick summary. Once again, buyers of options have rights, sellers have obligations, okay? So every contract is the right, in the case of calls, to buy 100 shares of stock on or before the expiration of that contract at their particular strike price, okay? So the seller of the call has the obligation to sell shares at any time on or before expiration. Puts are just the opposite. Puts are the right to sell 100 shares of stock on or before expiration, where the put seller is now obligated to purchase those shares should the put holder exercise their contract. All right, so let's dive into some basic strategies, okay? So before you get started, it always starts with a forecast, okay? So you have to ask yourself, okay, am I bullish? Am I bearish? Do I think the stock is just going to flatline and stay quiet for the next 3 months? Okay. If I'm bullish, how high do I think it'll go? If I'm bearish, how low do I think it'll go? And also over what time period? Okay. So, once again, options are all about, there's different durations for options. So you have to pick which expiration fits your individual forecast. Okay. So, options cost money. So anytime you're trading an option, further out in time that you go, those options are going to be more expensive. So if a stock is trading 100, the 100 level calls that expire in a week are certainly going to cost less than the 100 level calls that expire in a year. Because a year from now, there's a lot that can happen within a year. If I sell an option that expires in a year, I need to get paid for the risk I'm taking on for that option. Okay. So in the case of a regular stock, over a year's period of time, there's 4 sets of earnings. There's company specific news that can come out. There's geopolitical news that can come out. All kinds of things can happen over a year's period of time. So the further out you go in duration, the more and more those options cost. And that's called time premium. And time premium is what decays a little bit every single day. But just so you know, the further out you go, that's why those options are more expensive, because what you are buying is time. Now, once you decide whether you're bullish, bearish, or neutral, and what your time horizon is, then you can decide, well, what's the right strategy for you? Do I want to buy calls? Do I want to buy puts? Do I want to put on a call spread, a put spread, maybe something more of a complex option strategy? And one of the easiest things to do is to put on an options position. But not a lot of people get into the market with an idea of how they're going to exit the strategy. So it's always it's always going to help you to not only have an idea of where you want to get into a position, but where you want to exit a position. Okay. Just always have some kind of strategy, because options are not set it and forget it strategies. Okay. There's a lot of moving parts to options and a lot of things that can affect an option's value. We're not going to get into them all today, but just know that there are different components that can affect an option's value. Okay, so you want to have an idea of, if the option appreciates by X, maybe I'm going to take some profits, or if I lose X amount on my option, I'm going to cut my losses. So it's always handy to have an options exit strategy, because like I said before, it's easy to get into the position, but a lot of people get into a position with no idea how to exit the position. So it's really going to help you to have both a strategy selection and an exit strategy. Okay, so now let's get into some very basic strategies. So the first one we're going to look at is just buying a call outright. So let's just say the stock is trading for $140. And if I were going to go buy 100 shares of this stock, I could do that, but it would cost me $14,000, right? So, and if I buy the stock, if its stock goes up by $1, I'm going to make $1. And if it goes down by $1, I'm going to lose $1. Okay, pretty straightforward. Now, the call, I could look out on my options chain and in this example, buy the 140 strike call for $3.60. Okay, so this price of $3.60, okay, when you see a price in the options market, just understand that that price that you are seeing is the price for each individual share for that contract. So as every standard contract is the right to buy or sell 100 shares, you have to multiply those prices by 100 to get the true value. So if I buy this 140 level call for $3.60, it's in fact going to cost me $360 to own this contract. But as you can see, that's a very in comparison to buying 100 shares for $14,000, that's a considerable cost saving. So I can control the right, but not the obligation, to buy this stock at $140 a share for $360. So what is my break even at expiration? And when we look at these charts, we're always going to look at the charts from an expiration standpoint, because at expiration, this option doesn't have any more time value left in it. It either has value or it doesn't. So if we fast forward to expiration, okay, if the stock is trading for 143.60, in other words, the strike price that we paid, or the strike price of the option plus the premium that we paid, okay, $3.60, that gets us to 143.60. So with the stock trading 143.60 at expiration, okay, this option to buy shares at 140 is in the money. We would say it's in the money by $3.60. So we would neither make money nor lose money. We'd pretty much just break even. If the stock is above 360, we'd be sitting on an unrealized profit, okay? If the stock finishes anywhere below from 140 below, we would lose our entire investment, okay? So anytime you buy options, you know upfront what your risk is. Your risk is what you paid for those options. In this case, $3.60 or $360 per contract, okay? So that's our maximum loss, okay? So in the case with buying options, your risk is defined up front and your profit potential is undefined. In this case, if I buy this call for the 140 level call, theoretically, there's no limit to how high this stock can go, okay? If stock goes to 150 at expiration, well, now the right to buy stock at 140 is $10 in the money, okay? It's going to have $10 of what we call intrinsic value. It'll probably be trading close to $10. I paid $3.60 for it, okay? The difference, $10 minus $3.60, that's $6.40. I'd be sitting on roughly about a $640 profit if this stock finished at 150 come expiration. So once again, this is how you figure out your break even at expiration on your call options. And in this case, you also know your maximum loss. Now, for every option buyer, there's always an option seller. So let's look at why somebody might sell an option, okay? Now, this is called the covered call. Now, the covered call is for somebody who already owns the shares, who is looking to generate some income on their long stock holdings. So the covered call position is probably the most popular of all option strategies, because most people come into the options market already long stocks in a portfolio, and they start trading options because they're looking to generate some kind of income off their long stock holdings. So somebody who's putting on a covered call position is doing so because they are neutral to moderately bullish on their shares, okay? Because if you were extremely bearish on your stock holdings, you probably wouldn't own the stocks to begin with, or you might put on a different option strategy, okay? So selling calls doesn't really give you a ton of protection of the downside. If you were very bullish, well, you wouldn't sell calls on your stock holdings to begin with, because by selling calls, you're capping your upside, okay? So once again, to reiterate, you only put on a covered call position if you are neutral to moderately bullish on your shares. So in this case, we own shares of XYZ trading for $75. And we think that there's a very low likelihood of this stock going to 80 between now and its expiration. Maybe this call expires in a month. So we think we're going to go out and sell this 80 level call for $1.80. So what's our break even on this? Okay, so by selling this call for $1.80, remember we have to multiply the price of the option by 100. So we're going to take in $180. That premium is ours to keep. But by doing so, that has lowered our break-even price on our shares. We paid $75 for the shares. We took in $180 for the call. That gives us a new break-even price of $73.20. So if at expiration, the stock is trading $73.20, we would neither make money nor lose money on this position. Okay. Yes, we're going to lose $180 on our stock position, but we took in $180 by selling this call. Okay. If the stock is below $73.20 at expiration, we would actually lose money on our long stock holding. Now, what is the most that we can make on this position? Well, the most we can make is at our short 80 level strike. Okay. So if all of a sudden the stock rallies to 80 and sits there at expiration, well, we're going to make $5 on our stock position. At expiration, our 80 level call theoretically expires without value. We would keep $1.80 for a total profit of $680. Okay, but that is the most that we can make on this position is $680. So if all of a sudden the stock makes a huge move to the upside, goes to 90, well, we're still going to make $680, but we're going to forego the opportunity between 80 and 90. Okay. So once again, by selling this 80 level call, we are effectively capping our upside. Now, there are things you can do if all of a sudden, maybe you're a week before expiration, stock rallies to 80, and you're now all of a sudden your forecast is you're a little more bullish. Well, you could buy back this 80 level call and just stay long the stock, or roll it to another strike, maybe sell the 85 or 90 level strike, take in a little more premium. But once again, getting back to that idea that options strategies are usually not set it and forget it. They do require a little more attention than just holding stocks. So it may take a little active management if the stock starts moving around, but just know that you, should you get a sign on this 80 level call, if somebody decides to exercise their call, you're going to lose your shares at 80. You paid 75 for them. You're going to make a total profit of $680. So, we get calls all the time from people saying, well, I got a sign on this call and they're not happy about it. But remember, if you get a sign on a covered call position, what's happened is you've made the maximum profit potential on that position. That's all that's happened. You'd wake up the next morning, you'd have a bunch of cash in your account, and you would have to redeploy it elsewhere. Okay, so once again, you're only putting on this position if you are of the viewpoint that you are neutral to moderately bullish on your shares. All right, so now let's look at a simple put buying example. Okay, so if all of a sudden we're looking at a stock and we're going to look at a $200 stock and we're bearish on the stock for whatever reason, maybe the stock is about to report earnings, we think it's going to make a big move to the downside, shorting shares is a little risky, so we're going to look to buy a put option. So we see that we can buy the 200 strike put in this example, trading for $4. Okay, so every put is going to cost us $400. Okay, because remember, we have to multiply the price of that option in the marketplace by 100 to get its true value. Okay, so if I buy the 200 strike put for $4, what's my break even at expiration? Well, I have to take that strike price, 200, minus the premium that I paid, $4. That gets me to 196. So at expiration, excuse me, at expiration, if the stock is trading 196, okay, the 200 strike put is going to be in the money by $4 because it's the right to sell shares at 200, even though they're trading 196 now. And I would neither make money nor lose money. Below 196, I would have my puts would take on value 1-to-1 all the way down to 0. If all of a sudden stock goes to 190, okay, my 200 level put is in the money by $10. Okay, I paid $4 for it. I would be sitting on a profit of roughly $6. And I've got participation, all the way down to 0 for this put. Now, if the stock closes at 200 at expiration, well, in theory, my 200 level put has no value. This $400 that I paid for the put would just expire worthless. So the worst case scenario is I would lose my $400 investment. Now, if I shorted these shares and the stock goes to 210, okay, I'm going to lose $10 or $1,000 by being short 100 shares. But if I buy this put, the most I can lose is what I paid for it, $4 or 400 per contract in this case. So that's just basic buying puts, and people would buy puts to speculate on a bearish move to the downside. Now let's look at a protective put, also known as the married put. Well, if I own stock, okay, maybe I'm bullish on my stock, but I'm also kind of, maybe there's some news out there, maybe it's going to report earnings, maybe I'm worried about the downside. Now I could buy a put against my stock holding, which is called a married put, to protect myself in case shares go lower. Okay, so what is my break even if I buy puts against my stock holding? Okay, so I buy 100 shares for 120, and I'm nervous. I'm willing to absorb some losses, but I want to be protected if the stock falls out of bed and goes below 100. So I look at my options chain. I see I can buy the 100 strike put for $2 or 200 per contract. So what is my break even on this position? Well, you would take the price you paid for the stock, 120, add the premium that I paid for the put, $2, that gets me to 122. So at 122, at expiration, I would neither make money nor lose money on this position. Yes, I would make $2 on my stock, but I'd lose $2 on my puts because at 122, my puts theoretically have no value, so I would break even. But above 122, you can see that I have 1-for-1 upside on my stock holdings. If stock goes to 150, okay, I'm going to make 30 points on my long stock position. I'm still going to lose $2 on these puts for a P&L of $28, okay, or $2,800. So I get 1-for-1 upside on my shares above my break even, in this case, 122. What is my risk in this position? Well, the risk is my maximum loss is always going to be the difference between what I paid for the strike, 120, what I paid for the stock, minus my strike price, plus the premium on the puts. When I do all the math, my risk is $22 to the downside, or $2,200. Now, let's just say the stock closes on expiration at 100. You can see that I'm going to lose $20 on my stock. Theoretically, my 100 strike put would expire worthless, so I'd lose $22 or $2,200. But that's the extent of my losses. If all of a sudden stock goes to 80, okay, the most I can lose on this position is $22 because I own the right to sell these shares at 100, regardless of where the shares finish at expiration. Okay, so yes, I would have losses to the downside in this case, and I'm using the 100 strike put. Okay, this is just one put. There's probably 115 puts, 110 puts, 105 puts. Okay, but for this example, we're using the 100 strike put. But in this case, we know that our maximum loss in this case would just be $2,200. We're protected, and we get that 1-to-1 upside above our break even of 122. Okay, lastly, let's look at the cash secured put. So the cash secured put is a way for people to use options to acquire shares at prices that they're more comfortable buying them at. So what does that mean? So what if all of a sudden I'm trying to buy this stock for $140, and I kept putting in my bid, I kept missing it. All of a sudden, over the course of, say, a week or two, the stock trades up to 146. Well, I don't want to pay 146 for the stock. I'm not happy chasing the stock, and nobody should be chasing stocks. But I'm comfortable owning these shares at 140. What can I do? Well, this is where the cash secured put comes in handy. So if I'm sitting on a bunch of cash and I'm not, but I have a shopping list of stocks that I want to invest in, this is where cash secured puts might make sense. So now stock's trading 146, and I'm not interested in paying 146, but I'd be happy to buy some shares at 140. What can I do? Well, I could sell the 140 put, in this case, for $2. Maybe it expires in a month. Okay, so what is my break even on this position? Well, my break even at expiration would be my put strike 140 minus the premium that I took in, because remember, I sold this put. I'm taking in $200 per contract that goes into my pocket. That's mine to keep. My break even, should I get assigned on this put, would be 138, okay? Because if somebody exercises their contract and is going to put shares to me, I'm going to own shares from 140. But remember, I took in $2 for this contract, so my break even is at 138, okay? So if shares at expiration finish below 138, okay, I'm going to have 1-for-1 losses on the potential assignment of these puts. Above 138, I would have unrealized gains. Okay, if the stock finishes at 140 at expiration, well, this put in theory would expire worthless, and I would keep that $200, and now I can decide to either one, go out and buy the shares in the actual market. If I buy the 100 shares for 140, well, now I've got $2 that's going to offset the cost of that. Once again, gets you to that break even of 138. My true cost basis on these shares is 138. But or maybe I could choose to sell another put and take in some additional income, maybe at the 140 strike a month out, maybe the 135 strike. Once again, this is all going to be dependent upon your own individual risk tolerance and forecast. If the shares finish at 140 or higher, well, once again, these puts would expire worthless and you'd have to reevaluate. So this max profit, remember, anytime we sell options, we know what we have our gains are defined and our risks are undefined. Okay, so in the case of a put, well, you know, a stock can only go to zero, so we know our risk is down to zero should we get assigned on this put. But by selling this put for $2, now we know exactly how much we can make. So buyers of options have defined risk, undefined reward. Sellers of options have defined reward, undefined risk. So if all of a sudden, you know, once again, the max profit on this position would be $2 if this put expires worthless, but that doesn't take into account any resulting long stock positions should assignment occur. So once again, the cash secured put is, and they call it cash secured because if I sold this put for $2, okay, and my break even's now effectively 138, I have to pledge the amount of money that would cost me to buy these shares should the exerciser exercise their option. So I would have to pledge $14,000 in an account to secure the purchase of these shares. Well, actually, I'm really only putting in $13,800 because I took in $2 by selling this put. So I have to basically pledge the difference between my strike price and the premium I took in an account with my broker, just in case I was to get assigned on this put. That's why it's called cash secured puts. But it's a way for options traders to create income. You can almost think of it as a way to get paid to wait for shares to get down to a level that you're comfortable buying them at. So if I just sell cash secured puts and I have no interest in buying shares, well, that's just gambling. Okay. People who sell cash secured puts typically have a shopping list. They're sitting on cash. They have a shopping list of stocks that they would like to own, but are not comfortable buying them at where current prices are trading, but they would like to buy them on a potential pullback. This is where a cash secured put might make sense for you as an investor. Okay, now let's talk about really quickly the exercise and assignment process. So exercise and assignment. So what OCC does, I work for OCC, the Options Clearing Corporation, and we are the world's largest derivatives clearinghouse for exchange listed options in the United States. Okay, so we essentially clear and settle all the contracts that trade in the United States. So we also facilitate the exercise and assignment process. So an option buyer, remember that an option buyer in the case of calls owns the right, but not the obligation to buy 100 shares of stock on or before their expiration at their specified strike price. In the case of puts, the owner of that contract owns the right, but not the obligation to sell 100 shares of a stock or ETF at their strike price, okay, if they decide to exercise. So when you exercise a contract, you issue a notice to your broker notifying them that you would like to take control of either own the shares or deliver the shares. Okay. At expiration, if an option is a penny or more in the money, it becomes automatically exercised. Okay. So one thing to keep in mind, you just because you're trading options doesn't necessarily mean you have to exercise your options. So I want to throw some stats out there for you. So I know there's a myth out there in the options market that I don't know where it came from, but people, there's this idea that 90% of options expire worthless. So you should just sell options because most of them expire worthless, and it simply isn't true. Roughly about, we've looked at the data, and roughly about 72% of options contracts are closed out on or before expiration, meaning that people that own them either sell them out before expiration, or people that are short them buy them back before expiration. Okay, so about 72% of contracts are sold out on or before, or bought or sold back on or before expiration. About 6% of contracts are ever really only exercised, and the remaining 22% of contracts expire without value. So just know that the majority of options traders really have no interest in exercising their contracts. They're just trading the options to position themselves for a bullish, bearish, or neutral move with no interest in exercising those contracts. So only option buyers can exercise an options contract. So option buyers, if they choose to exercise contracts, sellers get assigned. So let's look at that process. So if I'm sitting on an options contract, and let's just say the stocks, I bought the 100 level calls and the stock is trading for 110. And I want to take delivery of these shares, and it's at expiration. If I do nothing, these options will be automatically exercised. Okay, so a notice would go from my trading or brokerage firm to my brokerage firm's clearing member firm, would then notify OCC, and OCC would facilitate that exercise of my contract. Okay, so once again, as I mentioned before, options that are a penny more in the money get exercised automatically. So if I did nothing at expiration, I'm sitting on the 100 level call, stock finishing at 110. By exercising this call, I would pay my strike price times 100, in this case, $10,000. And now I would take delivery of 100 shares of stock, now trading 110. So I'd be sitting on a $10 profit, but I also have to come up with the money to facilitate that exercise and buy those shares. So assignment is the process by which the person who is short the contract, who has the obligation to deliver or receive those shares, fulfills the terms of that contract. Okay, and for an option seller, if I sold a call, I have the obligation now to sell 100 shares of that stock or ETF on or before expiration. In the case of a put, I have the obligation to buy 100 shares of a stock or ETF on or before expiration at my strike price, should I get assigned. So assignment notices are received from the seller's brokerage firm. Only option sellers can be assigned on an options contract. So one thing to keep in mind, if you're trying to manage an options contract, the only way to mitigate against an unwanted assignment is to purchase back any short options on or before expiration. Because once you're assigned on an options contract, that's final. You can't, it's too late to manage your options position, because now your options position has turned into a stock position. Okay, so the only way to manage a position before expiration is to buy back any short options that you might have to mitigate against an potentially unwanted assignment. So let's look at the assignment process. So once OCC receives an exercise notice from the broker's clearing member firm, then we pair that exercise notice up with somebody who is short the contract. Okay, we net out the buys and sells, figure out who's long the contracts, who's short the contracts. We have a random process. It's an SEC approved random process. Okay, we just don't pick somebody at will to assign these short contracts to, but there's a random SEC approved process. We tell one of our clearing member firms who short the contract that they're being assigned. They in turn have their own process where they assign one of their trading or brokerage firms, and eventually that notice gets sent to you, the investor. If at expiration, if you were trading options on Friday and you got a sign, you probably wouldn't find out until Monday morning, and you'd be either long or short shares of stock. So, but this is how the assignment process works. So it goes from OCC. We match that exercise up with somebody who's short the contract at a clearing member firm, goes to a trading firm who's short the contract, and then eventually you, the investor, gets notified that you were assigned. All right, so let's look at, just in summary, I know that was a lot of information, but option contracts convey rights to buyers and obligations to sellers. There's two types of options, calls and puts. Call buyers have the right to purchase stock on or before their expiration at their strike price at any time that they so choose. Call sellers have the obligation to sell stock at their strike price at any time on or before expiration. Puts are just the opposite. Put buyers have the right, but not the obligation to sell stock at their strike price on or before expiration. And the put seller, by taking in that premium, is obligated to buy stock at their strike price at any time on or before expiration, should the long holder exercise. Rights and obligations are realized through the assignment process, which is facilitated by us at OCC. So I know that was a lot of information. And once again, this is just a 10,000-foot overview of options. There's certainly more to learn, and I encourage you to learn more about options because once again, as I mentioned before, there's a lot of moving parts to options. And once they're not really that complicated, but once you start giving yourself a little more education and understanding the product better, it's going to go a long way to helping you be a lot more profitable as an options trader. And hopefully, over the coming year or years, we can do more of these webinars. I can present on various topics related to options and some of the other risks and dynamics that apply to options. So with that, I know we might have some time left over. I'm going to bring back Jerry, and maybe we can entertain some live Q&A.
I learned a lot, and I just want to encourage all of our viewers to now submit questions. We have some time left over, and we will ask Ken some questions. Let's start with a few that we got in advance of this event starting. First one, excellent question. How does stock splits or reverse splits impact existing options contracts? So let's say I get something with a strike price of $100 a share. Next thing you know, there's some sort of stock split, as with we've seen recently in the market, and the stock is suddenly $10 a share. How does that play into things?
So nothing economically changes. That's called a forward split. And what happens is the stock is going to split, in your example, 10 for 1. Okay, so stock today is trading 100. On the day of the split, it's going to open up at $10. Okay, so if I own 100 shares of stock for $100, on the day of the split, I'm going to own 10 times as many shares at $10. So I own a greater number of shares at a lower valuation. So on the day of the split, I'm going to own 1,000 shares at 10 rather than 100 shares. I'm sorry, 100 shares at 100. So it's still $10,000 worth of stock. Okay, nothing economically has changed. So that's how a stock split works. Now with options, if I own the 100 strike call, okay, that strike price is going to get reduced by, in the case of a forward split, is going to get reduced by the split factor, in this case 10. So if I own one of the 100 strike calls on the day of the split, now stock's going to open up at 10. I'm going to own 10 of the $10 strike calls. I'm still owning the at the money strike call. I just own 10 times as many contracts. Okay, so it's economically nothing really changes. It's just option contracts are always going to be adjusted in the case of a split. Now, reverse splits are a little more tricky, and I know over the last um, over the last 2 or 3 years. Actually, it's longer than that. We've had a lot of reverse splits, and reverse splits are just the opposite. And a lot of times, somebody might enact a reverse split if they're trying to meet a listing requirement. Let's say a stock's trading for 10 and it falls all the way down to 1, and somebody decides to reverse split their shares 1 for 10. Well, now what's going to happen is on the reverse split day, that stock is going to open $10 higher. It's going to open 10 times higher. It's going to open at 10. Okay. But if I own 100 shares at $1 on the day of the split, now I'm going to own 10 shares at $10. Okay. So once again, nothing economically changes. I'm going to own now a lesser number of shares at a higher valuation. Okay. So for options contracts, and this is where people get in trouble with reverse splits. So on the day of the split, they look at their options montage and they see, oh my God, I can buy the stocks trading for 10 and I can buy the $5 calls for a nickel. I'm going to buy 1,000 of them. Well, you have to remember that those calls don't deliver 100 shares of stock any longer. They deliver 10 shares of stock. So in theory, that you have to multiply the stock price by the amount of the split, 0.10 or 10, to get the true value of that stock. That stock's still trading for $1. So by buying that $5 call, okay, you're buying a call that's $4 out of the money. That's why it's trading for a nickel. And they usually shoot first and ask questions later, and then they wonder why they lost money. And this is why. So anytime you're trading options and you see a numerical suffix after your option symbol, like a XYZ1 or an XYZ2, that number is a flashing warning, and it's telling you that the deliverable for the options contract is non-standard, meaning it's something other than 100 shares of stock. So that's when you have to do a little research. You can go to the OCC website, and we have a corporate action. We have an OCC memo section, and this is publicly available to investors. You can type in your stock and see if there was a corporate action that impacted your stock. But if there is a numerical suffix following an option symbol, that's telling you that deliverable is non-standard, and you have to do a little homework to figure out what it exactly is. So you understand exactly what you're trading. And I can't tell you how many people get into trouble trading these reverse splits, thinking that there's a bunch of free money out. There's no free money out there. Okay, those options are priced for a reason. And if you think there's free money out there, you probably need to do a little more research, because if it's too good to be true, or it looks too good to be true, it probably is. So
sounds like a mistake that I would make. All right, next question. Excellent question. What happens to the options price if the underlying entity enters into a partial divestment and sells away a significant portion of its assets or operations? Of course, anything can happen with the stock if that happens.
yeah.
If you get a bunch of cash, price could go up, price could go down. Any thoughts there?
Well, once again, so we have an entire group that's devoted to corporate actions. I can't comment on hypothetical situations, but every corporate action is treated on a case-by-case basis. But in what you're referring to, it sounds like kind of like if a company spins off another company, how does that affect my options contract? Well, once again, if XYZ spins off shares in ZYX, okay, well, shareholders in XYZ would have their ownership in XYZ, and then once the spinoff happened, they'd get some shares in ZYX. Same thing with the options contract. If the deliverable changes from something other than 100 shares, an information memo would be published saying that the options would, deliver X shares of XYZ and X shares of ZYX, and it would be a non-standard deliverable. And once again, I can't talk in terms of generalizations, because once again, every corporate action is different. But in a spinoff situation, that might happen. So once again, anytime that the deliverable is impacted by any type of corporate action, you'll see a numerical suffix after your option symbol. And once again, that's that flashing warning sign that you need to go to the OCC website or do a little more due diligence and figure out what exactly the deliverable is, so you can make an educated and informed decision about, trading those options.
All right, let's take one that we got in advance from Wonder. All right, hi. For spreads, e.g. calendar spreads, is it advisable to enter into the long and short legs separately, especially when market sentiment can take a sudden turn? Why don't you explain? That's kind of a high-level question. Go ahead and answer it, and maybe you can explain a little bit what terms we're talking about here.
So what they're talking about is legging into an options position. And, I've never been a good market timer. I can't, I wish I was. But, if you're a good market timer, you could certainly leg into an option spread. But a calendar spread essentially means, if I'm long a calendar, let's say I'm buying the stocks trading for 100, and I buy the 100 strike call that expires in 3 months, 3 months out, and I sell the 100 strike call that expires in a month, the near term one. So a calendar spread involves the same strike, different months. Okay. And somebody who's long a calendar is doing so because once again, that idea that I'm neutral to kind of, just I don't have much opinion the stock's going to move around much over the next 3 months. But then after 3 months, then if my near-term option after a month, my near-term option expires worthless, then I'm long the further term option, hopefully, whether it's a call or put, it makes a big move to the upside or big move to the downside. So most people who put on spreads don't typically leg them. They're usually doing them, buying one option, selling one at the time of the trade inception. But you can do whatever you want. You're certainly free to do that. I will have to mention that, if you buy a spread or sell spread, there's a risk defined nature there. But if you try and leg into a spread and start with the sell side, your broker's probably going to hit you with margin, because you're going to be naked short that option to begin with, even though you have the intention of buying an option against it later on. So just know that there may be some margin impact on you if you try and leg a spread and just start with the sell side. So just something to keep in mind.
Great. All right, let's continue with a little easier question, or a little more basic question. How does the strike price of an option affect its value? So I don't know if this person is talking about once you lock in, or you've got numerous strike prices to choose from. Why don't you talk a little bit about that?
So the strike price, and if you pull up your favorite stock on an options monitor, and you'll see various strike prices. Okay. You'll see if the stock's trading 100, you might see strikes all the way down to 10. Okay. Those would be all in the money strikes. And then, you have your at the money strikes, stocks right around 100, and then strikes above 100 would be out of the money strikes. Okay. So you have a variety of different strikes from which to choose from. And, in the case of calls, any strikes below 100 are always going to, and the more in the money those strikes are going to be, the more they're going to cost. The further out of the money you go, the less they're going to cost. Okay. So, the strike that you pick, once again, that contract, it's the right, but not the obligation to buy or sell 100 shares of that stock at your strike price. Your strike price doesn't change. That's the contract that you're entering into based on your forecast of, buying or selling those shares. Okay. So that's the terms of the contract. That's the strike. So, and once again, there's various strikes that you can choose from. I could do a webinar on spreads at some point and talk about, why somebody might put on a particular spread, either buy a spread or sell a spread. But, once again, it all gets back down to depending on how bullish you are, how bearish you are, how neutral you are. You can design an options position to fit just about any forecast that you might have. And this is the beauty and flexibility of options. And once again, people love options because of the leverage they afford you, right? So, you can control many shares of stock with a fraction of the investment that you would by actually buying or selling those shares. So in the open market. So, but you know, leverage is a double-edged sword. When leverage is going your way, it's a great thing. And when it's going against you, it's horrible. So, you know, you just have to understand that with leverage comes risks. And as long as you properly understand those risks, you're going to be fine. So
I've got time for a few more. This is a great question also. Will the option strike price adjust to a major cash dividend or a capital repayment? Ken, what's the story there?
okay, so in the case of ordinary dividends, an ordinary dividend is a dividend that gets paid on a consistent basis every quarter. So let's say stocks trading for, let's just use a very easy example. Stocks trading for 100 and it pays $1 dividend every quarter. Okay, that's an ordinary dividend. It can be anticipated by the market. The market kind of knows that every quarter when it goes X dividend, that stock is going to, so on the X dividend date, that stock is going to drop by $1. In other words, it's going to trade $99. The investor is going to lose $1, but then they're going to get, you know, $100 mailed to them in the form of a dividend. So they're made whole. There's no economic change there. For option traders, okay, obviously that any ordinary dividends actually gets priced into the value of the options because they, you know, you can anticipate on the X date that stock's going to drop by the amount of the dividend, and that gets priced into standard options contracts, okay? Special dividends or non-ordinary dividends typically are adjusted, okay, if they are greater than 12.5 cents, and they are considered non-ordinary, okay? So if all of a sudden some news comes out and the stock declares a a special dividend of $5, okay? And let's just keep it very simple. Let's just say the stock never paid a dividend before, but all of a sudden they decide to pay a special dividend of $5. Well, that wasn't priced into the options market, okay? So to make option traders whole, what they'll do typically is they will lower strikes by the amount of the dividend, in this case, $5. So if I own the 100 strike call, okay, and nothing happened and there was no adjustment, on the X date, my stock would drop by $5. Now I don't know you know, before I'd be owning the at the money strike call, and all of a sudden stock drops $5. Now I own the out of the money strike call because stock's trading 95. I'd be, you know, out a bunch of money. Well, by adjusting the strike, if the strike is adjusted lower by $5, now I own the 95 strike call. Stock drops by $5. It's trading 95. I still own the at the money call. I haven't been impacted adversely in any shape or form. And this is why option strikes typically get adjusted. So option traders aren't adversely impacted by a special dividend. If the dividend amount is greater than the lowest strike with open interest, let's just say the lowest strike on a particular stock is $2.50, and this company declared a $5 dividend. Well, obviously you can't lower a $2.50 strike by $5 because you'd have a negative strike. In that case, when the dividend is larger than the lowest strike with open interest, the deliverable gets adjusted. So in that case, the deliverable, instead of lowering all strikes by the amount of the dividend, you would say, okay, well, now the OCC would publish a memo saying the deliverable for these options is 100 shares of XYZ plus $5. So in that case, the deliverable, the $5 special dividend would get added to the deliverable, and it would be a non-standard option. But you know, that's in the case. That's kind of, you know, typically how most special dividends work. They'd either strike prices get dropped by the amount of the dividend amount, or the dividend actually gets added to the deliverable, depending on, you know, the situation.
Wow, I did not know that. I would have assumed you were just on your own there. All right, we're going to finish up with the last question here from Thunder Furies. All right, why do options sometimes enter a suspend mode, grade, color, and the pricing for several days, and then resume movement after that? This usually happens on options higher than 30 days to expiration. I'm not familiar with that, but perhaps you are. Ken, any thoughts on that?
What do you mean options get suspended? I'm kind of like, so
No, I think this person is indicating that perhaps he cannot trade the option for a period of time. Does that ever happen?
well, there are situations where a trading halt, if there's a trading halt, if a stock all of a sudden halts and it's not trading, the options are obviously going to be halted. Okay. So if a stock halts, you're not going to be able to trade your options. Okay. You can still exercise your options. OCC doesn't put contract restrictions on long contract holders. So if, and there are some weird situations, bankruptcies and, news comes out. Sometimes I've seen stocks halted for months for various reasons. You know, in that case, you cannot trade out of those options. You can still choose to exercise them if you want to, but OCC doesn't put exercise restrictions on contract holders. And also know that you could be assigned on those options if you're short those options, but you can't trade out of those options. And once again, getting back to a non-halting situation, sometimes options just don't trade for various reasons. An option has to trade, for its price to move, or the stock has to move for the price to move. But it's I think they're getting at a trading halt, but in that case, yeah, a trading halt would if the stock is halted, the options certainly will be halted as well. So it's the options aren't going to trade if the stock isn't trading.
All right, good to know. All right, Ken, great first educational step for people like myself who do not normally trade options. I'd like to thank you for joining us. I'd like to thank everyone for tuning in, especially since we started late and had some technical difficulties. Ken Keating of the OIC, thank you so much for joining us. Thanks everybody for watching. Have a great trading day. I'm Jerry Kronenberg. Take care.
Thanks, everyone. Thank you for joining us. Thanks, Jerry.